Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Today we're going to talk about once you're at a phase in life where you've paid off your mortgage, what do you do with the free cash flow? How do you structure that? And what are some tips and tricks that we do with our clients that make a huge difference that we really do recommend to do on your end? Before we jump into it, if you haven't checked out our fee-for-service financial planning offering, we'll put a link below. What we do is we offer fee-for-service financial planning, and we don't push it too much on this channel, or we try not to push it too much on this channel, but I know a lot of you watching these videos are looking for help. You don't know where to turn. You've never found a trusted financial advisor. We try and break that gap for you. So we offer fee-for-service financial planning where we grab your data, your information, your goals, your retirement goals, your estate goals, all that kind of stuff, and we kind of marriage it together and create a sound financial plan, retirement plan, tax plan, estate plan for you, your loved ones, to make sure that your retirement is on track. Okay, so we do this for many of you watching this, our videos. I know our calendar is booked into mid-September for calls to go through this with you guys. So, book a call. We'll put the link below. Book a call. We can go through it, tell you a bit more about what we do, see if it's a good fit for you, and help you build out a proper financial plan, retirement plan that's not attached to product. I know so many of you are either DIY investors or you're just tired of being sold products through your financial institution. So if that's you and you're looking for just a plan detached from product, give us a call. We can go through that process with you. And I'll just quickly note on that, a lot of you ask, do we help people outside of BC? Yes, we help Canadians right across the country and abroad. We work with a lot of you that are overseas. I know a few of you have commented on this, Norway, Germany, elsewhere, but we can help Canadians right across the country. So let's jump into it. So you've paid off your mortgage. So first off, congratulations. That is a huge milestone. Make sure you go out and celebrate. But you now have quite a bit of extra cash flow in your budget. And what we also find that if you have kids, if you fall into that category, a lot of times the timing of when your kids get out of the house and your mortgage is paid off, they kind of come together at the same time. So you may have free cash flow from mortgage being paid off, but also from kids being out of the house. So if that's you, just kind of, put what we're talking about on steroids, you have that much more money. So once you've paid off your mortgage, that free cash flow, we should start allocating that. Now we want to look at both an RRSP and a TFSA. Those are your two best spots. Okay, so if you have a decent income, a high enough income that it makes sense to do an RRSP, and we have many videos on what that threshold is, but if it makes sense to do an RRSP, start contributing to an RRSP in a more aggressive manner. Okay, you're going to get the nice tax break, and it's going to fit into a nice overall financial plan down the road. If you haven't maximized your tax-free savings account, start to utilize that as well. We've talked about it many times. It is very, very handy to have a funded tax-free savings account in retirement. Now remember, you can invest in your tax-free savings just like you can in your RRSP, okay? A lot of financial institutions have butchered that. A lot of clients come into their office, say, my tax-free savings is in a savings account, earning nothing. And it's been like that for 10 years. And they didn't know that they could invest it. They didn't know that they could let it grow and grow tax-free. So the whole purpose behind the tax-free account is to let it grow tax-free. And some of you we've talked to, you have $1 million in your tax-free because you bought Tesla, many years ago and you've done very well, or whatever the situation is. So some of you have used it very well, some of you not so much. So a TFSA account is an account to start plugging away at. If it's for long-term, get it invested. It could look identical to your RRSP essentially. So, start using your RRSP, start using your TFSA. Now, those are kind of the two best places. And just look at, tax rates, what you make, how much you need to allocate to each side. So just pull up a tax calculator online and say, well, I make $80,000 a year. I want to get my income down to about 50 or 60. So I need to put $20,000 or $30,000 a year. If you have extra, start building up that tax-free savings account. Now, for some of you, maybe you have a pension, whatever it is, you have no RRSP contribution room left, and you've already maxed out your TFSA. Okay, that's a great problem to be in. We do talk to quite a few of you in this situation, so I know it's common enough. So if you're in that situation, where do you put this extra money? Okay, there's three places that I see that are a good fit for this extra money. Okay, spot number one is a non-registered investment account. Okay, again, a way to invest your money, keep it growing. Now, you need to be aware that anything that you make in that account is going to be taxable in the year that is triggered. So, if you get paid dividends or interest income, or you sell a stock and make a gain, there's going to be tax paid in that year. So be aware that this could bump up your taxable income. Not ideal, but it's still another place to put money and invest it. We're going to do a video next week on non-registered investment accounts, how to structure those, Do you do a joint or single life? All the scenarios around that. So stay tuned for that. The second place to put that money. So again, this is if you've maxed out your RRSP, you've maxed out your TFSA, you're on a good track for retirement, but you have this extra money that you were paying to your principal resident mortgage, and now you don't know what to do with it. Okay, again, a great problem to have, but we want to make sure that we give you solutions to this so you can plan properly. The second option would be to upgrade your house. Now, a lot of you are going to fight this. Leave comments. Yes, I know. I truly believe that there's only two ways to grow money tax-free in Canada. It's through a tax-free savings account, and it's through your principal residence, okay? Now, if one is maxed out, if your TFSA is maxed out, and once your mortgage is paid off, technically your home is maxed out as well. Your tax-free savings account, you are unable to get more contribution room until next year. And every year you just get a little bit, but it's not a whole lot. Your principal residence, there's no limit on it, okay? So you may not need a bigger, more expensive house, but run the numbers, work with a financial planner if you need to, but it makes sense a lot of time once you have everything maxed out and you still have a lot of cash flow to upgrade the house, okay? So go upgrade your house. Yes, you need to get a mortgage, but now you can start putting the cash flow towards that. Yes, there's a bit of interest that you're gonna pay on your mortgage, I understand that, but you're also buying a bigger asset. Real estate has typically done fairly well, or at least, done what the stock markets have done almost. So be aware of that. So buy a new principal residence, start paying into that mortgage. You have a bigger asset. And again, the growth on that is going to be tax-free. So it's really another way to, boost up a tax-free savings account. Again, tax-free savings account, principal residence. Those are your only two ways to grow money tax-free. One is capped, one is not. So take advantage of that. That is one tool that I use personally. I think it's a great tool to use, and I will continue to use it as I get closer to retirement because I want as much of my money to go tax-free as possible. I have 4 kids, and my kids are 2, 4, 6, and 8. Okay, they're young. It's a grind. That's probably why I have no voice right now, because I don't get a lot of sleep because they keep me up. But at the end of the day, I need to grow as much money as I can tax-free, so that when they come knocking on my door and say, Dad, I need help with a down payment on the house, I've been able to compound my money as efficiently as possible. So if that means my wife and I keep upgrading our house over the next 10, 15, 20 years, at some point we would downsize, cash out a lot of that cash, tax-free, and be able to gift it to our kids on a tax-free basis. So again, just a strategy there that I use myself. I like to pass this stuff on to you guys. I think it's a great tool, and it's a great way to help your money grow tax-free that you'd be paying tax on otherwise. Okay, so I promised 3, right? So if your mortgage is paid off and you have this extra cash flow, we've gone through 2 of them, a non-registered account and upgrade your principal residence to kind of create more of a tax-free account. The third one would be to start gifting money away now, okay? So if you have kids, loved ones, a lot of you we talked to, it's a niece or nephew, maybe it's a charity. If you've run your financial plan and you're on track and this is extra cash flow you don't really need, you can start traveling and kind of start easing into the retirement lifestyle at this point. You can also start giving it away. So if you have kids, grandkids, if you have someone in your life that you want to help, maybe you were thinking when you pass away, why don't you fast forward that process and start helping them out now? Hey, let's say it's kids, just an easy example. You have that free cash flow. Your kids are probably in their 20s at this point if your mortgage is paid off. Maybe you paid off a little bit early, they're teenagers, but say they're in their 20s, in their 30s. They could use that money now, whether it's to pay for education, a down payment on a home, condo, whatever it may be. So they have a financial need right now. So if you've done proper planning, you know that this is kind of extra cash flow, money that's going to go to them eventually anyway. Gift it now. See the benefit of them using it now, and you're really going to help kind of jumpstart their path to financial freedom as well. So that's kind of the third idea. Again, it kind of has to line up with what you want to do with your money and what you're able to do with your money. But if this is truly extra money, it's going to go to the kids or nephews or whoever it is down the road anyways, maybe think about, fast forwarding that gift. Now, the last tip I have for you, and it's a bit different than what we've been talking about, but you've paid off your mortgage. Make sure you set up a line of credit against your personal property, okay? So, you paid off your mortgage, I'm mortgage free, but going to your financial institution, your mortgage broker, whoever it is that you deal with, and get a line of credit set up against your house, okay? The reason for this is manyfold, okay? You want to have a registered title against that. So I'm not a mortgage broker, I don't know the ins and outs of all this, but my mortgage broker and all the mortgage brokers I know have always said, make sure you have a registered loan against the property, because there's something called property theft. And if there's a mortgage or line of credit attached to that, it just deters people from trying to steal, title of the property essentially. So I won't go into that in this video, but it is something to consider. But I look at it more from a financial planning standpoint. If you have that line of credit, there's some things that you can do with it. And I'll give you an example of a family member that used this. So they paid off their mortgage free, but they had a nice sizable line of credit against their principal residence, about 80%. Okay. What they did is, a couple years before they retired, they decided to kind of buy or build actually their retirement home. And so what they did is they used that line of credit to fund the build on their retirement home. Okay. Now you have to be careful, because it's like everything in life. If you want or need a line of credit, it's very difficult to get one. That's just what I find. When you don't need it, the banks will give it to you no problem. Okay, so get this set up when you're working, you have good income, you don't need it. That's when you want to set it up. You're not going to use it, so it's sitting there, it costs you nothing, it's free. But when you need it, whether it's an emergency, whether you want to do a house build like my family member did, where they could access that cash, it was to them, they were just utilizing that equity that they built up in their house to build a new home. Okay, and maybe your retirement plan may be to downsize the house and use that money for helping your kids out. Okay, well, now you have a line of credit. You could actually help your kids out when you sell your house, pay off the line of credit. So there's just more tools that you can use with a line of credit on your home. So think about setting that up. I think you should have one set up before you pay off your mortgage, but definitely when you pay off your mortgage, get a line of credit set up, even if you don't need it. It's just that buffer for planning down the road. It gives you a lot of options. And trust me, in your 70s, if something happens and you need to do line of credit, it's probably not going to be available to you. So get that set up now, get it set up for long term, and you'll be thankful that you have it down the road. So thanks for joining us in this video. Again, if you paid off your mortgage, huge congrats to you. Start working towards your RRSP, TFSA, building those up for retirement. Again, if those are maxed out, look to upsize or upgrade your principal residence. Not because you need a bigger home, but because it makes sense on a tax efficient manner, letting that money grow tax free. So thanks for joining us in this video. We'll see you in the next one.